A rough week for the banking industry.
The collapse of Silicon Valley Bank.
The second biggest bank collapse in U.S. history.
The collapse of Silicon Valley Bank marked a significant event in the intersection of finance and technology. As a major financier for tech startups, SVB's downfall stemmed from a strategic investment missteps during a period of fluctuating interest rates. This crisis highlights the precarious balance between banking practices and the volatile nature of the tech industry. The collapse of Silicon Valley Bank raises the question, was it a banking or technology crisis?
Bismillahirrahmanirrahim. Assalamualaikum to everyone here. So first of all, I'm glad to welcome all of the members to the meeting and thank you for being present to this meeting. So now, can we call this meeting to order?
Yes.
As we know, Silicon Valley Bank clients are mostly from tech and startup companies. When all these companies raise a lot of money, they will deposit that money in Silicon Valley Bank since they are not using the money all at once. In 2019 to 2021, these tech and startup companies made a lot of profit, which tripled the money compared to their normal deposits to Silicon Valley Bank. Due to the huge amount of deposits received, Silicon Valley Bank makes use of this opportunity to invest them in order to avoid it from eroding due to inflation. Silicon Valley Bank took the decision to invest the deposit to the relevant government bonds and mortgage-backed securities. The downfall actually started here, where they ended up buying close to $100 million worth of government bonds and mortgage-backed securities. At the time they did it, the interest rate were really low, which was around 1.5%. At that time, global interest rate were slowly creeping up. When interest rate increases, the price of bond, which was the asset that Silicon Valley Bank has bought, declined. This is considered as the inverse relation of interest rate and bond price. So the scenario is that Silicon Valley Bank bought 100 million worth of bonds at one price and interest rate went up, so the bond price dropped because interest rate went up. So that $100 million that Silicon Valley has invested was a lot less. So they got a lot less money in return compared to the given money from their depositors. Bank run was the major factor of the downfall of SVB. The scenario of bank run for SVB is that the amount of money SVB has when the customer demand for withdrawal is insufficient. The major factor sparked the bank run is when the government announces that the interest rate spike up and the price of bond decline. After getting the news, FVB took the decisions to sell some of their assets to the market in order to recoup some losses, but they are still at loss because the assets are worth a lot less now. As they were selling some of their assets, their customers sensed and found out that SVB were making weird sales at the moment and assumed that there were issues with SVB. With that, most of the tech companies and the depositors ran to Silicon Valley Bank and started withdrawing their funds.
In general, as we know, the bank functions as an intermediary between the party with the surplus and the party with the deficit. For those who are in surplus unit, they will keep their money in the bank, while the bank will use this money to give loan to a deficit unit. In addition, most banks, especially SVB, use short-term deposit to invest either in security bonds or loans that have a longer maturity to increase bank cash inflow. What happened to this Silicon Valley Bank is that this bank focused on giving funds to the technology sector. During the era of technological development, this SVB took around 94.4% of new deposit fund uninsured depositor to be invested in a long-date fixed income security such as US government bond, mortgage-backed security by US government agency. However, the collapse of technology sector from November 2021 due to the COVID and onward caused many depositors consisting of corporate group to withdraw their money. This happened as a result of SVB network decreasing. When technology companies are aware of this issue, of course, more than 40 billion fund immediately want to issue uninsured deposit out of SVB. This bank run situation caused SVB to be unable to satisfy depositors' demand. Therefore, SVB had to sell hold-to-maturity securities due to lack of cash reserve and short-term liquid securities. However, at that time, interest rate had increased, such as US federal fund rates increased from 0.25% to 4.751%. As a result of the inflation problem, when the interest rate increased, the present value of HTM security decreased. That is how the interest rate effect on SVB securities value.
So the collapse of SVB had a big impact with some implications to the financial system. It includes impact on startups and tech sector, changes in banking practice, and long-term structural changes. So first, let's talk about how the event had an impact on startups and the tech sector. SVB is known as an important financial partner for many companies such as startups and tech companies. They provide banking services, venture debt, and other financial products for these companies. When this happened, it had caused a problem for this company in getting funds. Thus, this led to potential slowdown for growth in the tech sector. SVB also gave impact to the changes in banking practice. How? The demise of SVB is due to the classic bank run driven by a liquidity event. But this incident gave important lessons to the financial sectors, including other banks. The other banks may alter their practice by diversifying their asset portfolio, raising the liquidity management, and being more careful in lending practice. This guide is to more conservative banking operation. Also, we have to know that SVB leads to structural changes for the banking sector in the long term. This includes consolidation, since weaker banks will be absorbed by the stronger bank. It could also encourage other banks to make innovations in financial services, as the institution need to differentiate themselves and control risk more effectively. It is the second largest collapse of a bank in recent history. Of course, at some point, it affects the stock market. The fastest effect was the decline of bank stock. This is because most of the investors became more concerned about the situation during that time that the other banks will encounter the same issue. It led to a widespread selling of bank shares. The collapse of SVB had an impact on the stock market all around the world. For instance, in London, the Financial Times Stock Exchange FTSE 100 index closed at 2.6% lower, even after HSBC bought SVB's UK arm. Meanwhile, the stock market in Europe also decreased due to this event. It shows how the collapse of SVB led to more secure lending conditions, causing the gradual economic growth.
Following Silicon Valley Bank's failure, authorities moved quickly to resolve the issue and lessen its effect. Some of the significant measures that the regulators took were deposit insurance guarantee, in which all deposits at SVB are guaranteed by the Fed, the US Treasury Department, and the Federal Deposit Insurance Corporation. This assurance went above the standard of $250,000 insured deposit cap per account. This was guaranteed that in the event of the bank's demise, depositors would not incur damages. The next measure is Program for Bank Term Funding, BTFP. The BTFP was established as a reaction to the bankruptcy of SVB. When banks experience significant deposit withdrawal, the BTFP acts as a lender of last resort. Through the BTFP, banks can exchange assets such as US Treasury bonds for cash at face value, which is independent of the current market value. The interest rate on the loans is based on the 1-year overnight index swap (OIS) rate, and the maximum period is 1 year. Basel III is a global regulatory system designed to improve the stability of banks. However, the SVB collapse exposed the weaknesses in the regulatory system. To address the potential recurrence of such crises, Basel III had established the minimal capital needs for banks, wherein a specific amount
amount of capital must be maintained by banks in relation to their risk-weighted assets. Banks had to hold a minimum of 2% capital under Basel II. This minimum is increased to 4.5% of common equity by Basel III. As a result of having a larger capital base, banks become more resilient and better suited to withstand losses during economic downturns. To add, Basel III requires globally significant banks to have larger capital buffers in order to mitigate systemic risk, in which Basel III established a 2.5% buffer for capital conservation. This buffer makes sure that, in time of economic strain, banks have an extra layer of security. As banks have sufficient money, the institutions are able to withstand operational risk, market volatility, and credit losses. Consequently, the banking industry is healthier overall as a result of this risk minimization set by Basel III.
As we know, SVB has undergone substantial transformation since the collapse. Currently, SVB operates as a division of First Citizens Bank. This shift took place in March 2023 when First Citizens Bank bought the majority of SVB's assets. In March 2023, First Citizens Bank paid $16.5 billion less for loans and deposits totaling around $72 billion, acquiring the majority of SVB's holdings. The remaining $90 billion in assets are still under the authority of the Federal Deposit Insurance Corporation. A 2023 Yahoo Finance News article claims that this transaction represents a big start for First Citizens Bank. It shows their dedication to upholding SVB's customs and growing their presence in significant places. First Citizens aims to improve their high-touch service for high-net-worth clients by utilizing SVB's well-established expertise in private wealth management. This action also improved their standing with private equity and venture finance firms. Government and financial authorities took action decisively to strengthen risk management and resilience in the banking industry in the wake of Silicon Valley Bank's failure. The United Kingdom Minister of Finance plans to enhance small bank failure management in 2024 with the objective of achieving more effective resolution. In the same spirit, by the end of 2023, the U.S. Federal Deposit Insurance Corporation recommended new governance regulation for risk management at U.S. banks. In addition to these regulatory measures, banks have been continuously improving their risk management practice with the goal to avoid future crises and ensure better financial stability.
Brilliant analysis, everyone. However, I believe preventive measure is needed to fortify our bank against comparable crises. So I would like to hear from all of you your strategies in preventing this issue happen to our bank.
Looking at risk management perspective, I think reliable risk management practice is needed. Implementing rigorous risk management techniques such as detailed credit evaluation, stress testing, and regular loan quality monitoring can assist in identifying and mitigating possible credit issues before they rise. This entails closely monitoring borrowers' financial health and performance, and also we need to do market adjustment.
From financial division perspective, loan portfolio diversification is a great suggestion. This is to reduce the risk associated with sector-specific downturns. We might diversify its loan portfolio beyond technology and venture capital by lending to a larger range of businesses or using a more balanced approach to risk management. We can decrease its exposure to economic swings in any single industry.
From compliance division perspective, continuous regulatory compliance should be done, in which we must stay up to date on regulatory developments and ensure compliance with applicable banking regulation in order to avoid regulatory pitfalls and associated fines or penalties. Investing in strong compliance systems and cultivating a regulatory aware culture can assist the bank reduce regulatory risk while also maintaining its reputation and credibility. We can benefit from strategic alliances and cooperation with other financial institutions, technology enterprises, and industry players.
From operating department point of view, I think we need transparent communication and investor relation by maintaining open communication with stakeholders such as depositors, investors, and regulators is critical for establishing and maintaining trust in our operation and financial stability.
Openly sharing risk management techniques, financial performance, and corporate governance process can help to reduce uncertainty and increase trust in our long-term survival.
Great suggestion, everyone. So I would like to add from my perspective is that strategic partnership and collaboration, we can strengthen our resilience and diversify our revenue stream by forming strategic alliances and collaboration with other financial institutions, technological companies, and industry players. To enhance our capabilities and market reach, collaboration may include joint ventures, co-lending arrangement, and alliances with complementary services providers.